Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Welcome to today's show. Frazer Rice, I am so excited to talk to you today. You are the author of an absolutely fabulous book titled Wealth Actually, and the host of a podcast by the same name. So I really encourage everybody to go get the book and follow the podcast. You went to law school, you went to Emory, and you went to undergrad at Duke University, and you are helping ultra-high net worth families navigate the burden of decision-making when it comes to managing their assets. And you've had some really interesting leadership positions, including leading the Estate Planning Council of New York City. How did you get into this mess in the first place?
Oh, well, first of all, thank you for the kind introduction. I practiced law for a little bit after sort of deciding in law school that wasn't going to be what I wanted to do forever. I then went to wealth management, worked for Wilmington Trust for 16 years, got a deep fiduciary experience, and now I work with Next Vantage, which is a part of Next Capital Management. And we try to sort of reduce the complexity and help people get their arms around not only what they're putting together, but then how they administer it going forward, which can be a big challenge as people get wealthier and have more complexity in their lives and sort of bring on more people that their wealth touches.
The reason I really wanted to dig into this topic with you today is we had a big piece of legislation this summer, H.R. 1, the One Big Beautiful Bill. I believe I've got all the B's in there. Given your experience with tax planning, estate planning, and your law degree, you might actually help us understand what's in that bill.
Sure. So just for a tiny bit of context, the TCJA was essentially a set of tax rules and regulations and implementations that were set to sunset in 2026. That created a whole bunch of instability around tax rates, brackets, exemptions, a whole bunch of things. Ultimately, Congress and the president had to decide what to do vis-a-vis budgeting and to put some stability around that. Because whether you're wealthy or you're starting out or whatever, if you don't know what you're looking at from year to year, it's tough to make really good allocation decisions. It's tough to make tax planning decisions. And it was decided to go ahead and put some permanence around that.
And we're going to get to the topics that are probably most relevant to people with large estates in the tens and possibly hundreds of millions of dollars, but starting from a common ground of tax brackets and tax rates. So tell me more about that stability component.
Sure. The brackets and the rates were kept and made permanent. That's a big deal because when things change, you end up having to do certain things in order to either front load expenses or revenue or backdate them depending on what things are going to do. We essentially got by permanence, and put that in air quotes because a future Congress and a future president could legislate this away. With that permanence, you get a little bit more stability in terms of being able to plan.
Got it. So as permanent as things can be in American politics. So the next thing that people, of course, talk about is deductions. So tell me about that.
Sure. So state and local taxes are a big deal. If you're in New York, California, Illinois, et cetera, the ability to deduct them was considered to be a nice thing, especially for high-earning executives. TCJA essentially reduced the deductibility and put a cap around that at $10,000. One thing that came out of that was something called the pass-through entity tax sort of workaround, which allowed people to shift the payment of those state and local taxes to the entity level, and that allowed for increased deductibility for that. So this new legislation does something that's really good for high earners in that scenario that have pass-through entities, and they made that PTET permanent. This applies to all sorts of S-corps and LLCs and things that are pass-through, consultants, lawyers, healthcare, all sorts of things like that. And what that does is that allows that PTET workaround to continue. Additionally, the SALT deduction was increased from $10,000 to $40,000. That sounds amazing, except for the fact that it ratchets down as you earn more money. So as you go up to $500,000 in earnings, it ramps down and the effectiveness is fairly muted. And we talked about sunsetting a little bit. This sunsets in 2030. So while we had some things that are permanent, this SALT deduction on its face isn't permanent, and it's not that effective ultimately for high earners as you move up the scale.
Sure. And so we knew about the SALT deduction going from 40 to 10 back to 40. The PTET deduction, is it also capped at 40 or is it?
No, it's much more generous than that.
Right.
It depends sort of on your circumstances. But yes, the PTET is a workaround that high earners deployed artfully and quickly once that became apparent with the previous tax law.
Right. So if you're running your own entity as opposed to being a W-2 earner, the PTET is really a powerful tool, I guess is the best way to describe it.
Correct.
We just introduced the concept of how all of this plays out for people running businesses in a variety of ways. Tell me about QBI, what it is, what it meant, and I guess where it is now.
Sure. So Section 199A, for those of you who are already sort of trafficking in that, that's essentially the code section that this works around. So for qualified trades and businesses, you have the ability to deduct 20% of your income essentially through this. What was interesting in the new legislation is that the effectiveness was enhanced. It increases the bandwidth of income for those folks to be able to employ that. Essentially, this is something that came about previously, and there was a real worry that this was going to be limited going forward, and it turns out it was expanded.
Got it. Okay, so we've talked about PTET, we've talked about QBI, but now that we're tracking down the path of not just running your own business, paying your state and local taxes at that level, being in a trade that actually allows you to deduct some of your income, the next thing is, of course, for people that are really building wealth and building businesses. In a lot of cases, they have equity in the businesses they started. And there's a thing called the QSBS, right? And the fact that under certain circumstances, if the shares of a business were acquired in a particular set of circumstances, there's a really advantageous tax treatment if and when you liquidate those shares. Tell me more about that.
Yeah, so for those people who are starting businesses, the QSBS expansion, and I'm going to go so far as to call it that, is a way to reduce the capital gains impact upon the sale of the business that you built. This is code 1202, so if you want to go into the IRS and confirm that this exists, that's where it is. Essentially, 100% capital gains is retained for QSBS stock, and there's a whole bunch of technical things that have to comply with that. But it used to be that you had to wait 5 years in order to do that. Now, you only have to wait 3 years, and you can get 50% of the benefit of that. 4 years, 75%, and then the 5 years, 100%. So we're getting a lot of inbound inquiries as far as for people who have this QSBS stock or who are founding a business, what does that look like now? I think back in the day, people would see 5 years and put off the decision, and that's a long time away. 3 years and getting the benefit of capital gains exclusion really, I think, has wakened people up on that front. The per issuer exclusion is the greater of $15 million, and it gets indexed going forward, or 10 times the taxpayer's aggregate adjusted basis. So that means the gross asset test for the company is $75 million. So for entrepreneurs, this covers a lot of different people. Ultimately, one of the things that is where I would sort of think about it in terms of estate planning is the ability to take chunks of this stock and to put it into different trusts for the benefit of different people. You can basically take $15 million chunks and spread it across different trust entities in order to get capital gains exclusion going forward. So if you're in an estate planning frame of mind anyway, you can also have your capital gains tax exclusion and eat it too, essentially. Now, lots of caveats to that. The trusts have to be non-grantor, meaning the trusts have to pay their own taxes. The $15 million is for stock issued in 2025. Going backwards, that limit is $10 million for stock issued previous to that. But this is something that's very interesting. One key to think about this, though, is that this QSBS stock, you have to be extremely careful that any moves that you make do not poison your QSBS status and sort of get rid of the ability for you to take that capital gains exclusion. But the headline on all of this is that for QSBS planning, if you are in the formation process or you have a business that's in place that might qualify, you could have capital gains exclusion on the first 15 million of proceeds if you do your planning correctly.
And this is where we should insert the very obvious statement that nothing here is precise and this is not tax advice and there's so many details here.
This is idea spotting, and you need to go and assemble not only your accounting squad at the personal and corporate level, but also your legal squad, which is sort of corporate and estate planning wise.
Right. So to keep it simple, I'm going to make the caricature statement of don't try this at home. But I guess the way I'm understanding it is you start a business or you're at the early stage of a business. This doesn't qualify. That requires a certain class of business, right?
It has to be a C Corp. S Corps do not qualify. So we are getting a lot of different inquiries as to whether you can convert from an S Corp to a C Corp. I would say the answer is it depends. And so you have to go through a definite analysis of that. LLCs generally don't unless you make a C Corp election. And that's a tax concept, not a legal entity concept. All of which is to say that there are a lot of details to work through and an analysis that has to happen to see whether you qualify. But as I said before, especially if you can really see a path to a big exit, it can very much be worth it from a capital gains perspective.
Right. And I think that's exactly right, which is a lot of this is a lot of fancy footwork. And you're probably not going to want to go through all of it if you don't actually see massive gains down the line, because it might just not be, again, certain things get really exciting for people, but not everything is for everyone.
One last caveat before we move on is that there are certain businesses that don't apply. So if you're financial services or you're a farm, that's not going to work. If you're built basically around the reputation of one person, that doesn't work either. So there are lots of different caveats to that and part of an analysis that you have to go through.
Yeah. Well, I guess, again, we started talking about it, but tell me more about the estate and the gift tax exemption and all of that.
So this is really something that is sort of my bread and butter and I have to deal with a lot. One thing that was interesting in the TCJA was that the federal estate tax exemption indexed for inflation was essentially going to go, let's call it 14 million in 2025 and then go back down to 7 million. And there's a big formula for how to do that. But essentially, a lot of conversation that took place over the last couple of years was to lock in this exemption for federal purposes before it may be slightly taken away. What the OBBBA did was it made it permanent, and it starts at $15 million per person, which is a lot of money, even for wealthy people, in terms of being able to provide planning to use irrevocable trusts and other types of planning mechanisms to transfer wealth from one generation to the next. And, the idea here is that this has been made permanent too.
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode. All right, so I feel like we've covered certainly the headline considerations when it comes to HR1. And in a lot of ways, that felt like the tease for the important conversation. I want you to really take us to the more in-depth part of what you think is really critical here when people think about planning in general, in particular, again, when you're reaching that level where we're talking about millions, we're talking about tens of millions, and getting it right is critical because getting it wrong can be so painful.
I think you start out with the balance sheet. First things first, you have to understand what you have and how it's owned before you can really make any decisions. Because if you create a situation where you've done the best estate planning ever, but then you're not liquid yourself, you haven't really done anybody any favors. If you've done amazing estate planning, but you haven't really addressed a capital gains tax issue or dealt with income tax scenarios in any way, shape, or form, you haven't really thought that through very well either. And so in general, from a process perspective, I really encourage clients to start with the balance sheet and say, okay, what do I own? How is it owned? Meaning, do you own it, with your spouse? Is it owned individually? Do you have trusts that own things, et cetera? What's in your estate versus what's out of your estate? That initial balance sheet is going to be sort of the most important thing to start with. The next step, I think, in many ways, is to make sure that you have an inventory of not just the assets, but the documents that you have in place. The wills, the trusts, the healthcare proxies, et cetera. I find that a lot of people, they come to me with a big set of file boxes, and I have to kind of make sense of all this and then sort of help them understand. And when you're dealing with wealthy people, oftentimes they're really well represented. They've got smart people, they've got accountants and lawyers, but it can be transactional. And you've done all this quote unquote great planning. It's stuck in between the ears of generation one. And then when you're forced to make decisions under maximum stress, usually when somebody dies or something happens, Then all of a sudden you've got this fire drill. What's in place? How does this work? Do I have access to this? Who do I call? That type of thing. Who are the family members? Who are the advisors? Who are the people occupying the roles as executor, trustee, trust protector, investment advisor, insurance person? Get them laid out in a place that is of ready reference. Have an inventory of the different documents that are in place, and then have summaries of what those documents say, so that when you have to go through and figure this stuff out, you're not having to go through a 70-page document and look for a clause that you don't even know what it means and try to deduce all of this. Meanwhile, you don't want to call the lawyer because that's going to cost you $1,000 an hour, et cetera, et cetera. So it's to try to congeal all of these different factors into a playbook so that you understand what's in place and how. Then understand, certainly in estate planning perspective, what the balance sheet looks like if something bad were to happen to, one of the generation one or whomever passes away, what that looks like from an estate planning perspective. The red brackets in the balance sheet that sort of show what I think the estate tax liability is going to look like, that tells me what I have to chip away at and where the planning can go to chip away at those tax implications. We try to stir in philanthropic components when people are interested in that, where they're trying to figure out whether charity is part of it. That can be one of our tools to chip away at those red brackets of estate tax liabilities. And then really the thing that's modern in all of this is understanding the interplay between the capital gains tax implications and the estate tax implications going forward for people who have large businesses, who have concentrated positions in a Google or a NVIDIA or something like that, and trying to make decisions on where to locate assets so that you can minimize the overall tax bill and at the same time work on that third time dimension of what is the wealth going to look like once you've passed away. Against all of that backdrop, then you're starting to think about all of this, the idea of having big chunks of wealth in these scenarios for the benefit of kids and other constituencies, whether charities or otherwise. The biggest threat to wealth, in my opinion, isn't so much the tax planning and that. There's lots of smart people who can, as I like to say, put on their mad scientist cap and come up with the most tax efficient way to do things and so on. If you have kids in place who are fighting, who don't understand why, have bad habits, creditor issues, etc., if you don't understand how to defend against those types of things, the wealth can be destroyed just as easily as if you didn't bother to file a tax return. Overspending, lawsuits, divorce, etc., special needs scenarios for those people further with a different income level, etc., making sure that people like that are taken care of and that decisions are made around not only the staffing, but the decision-making process to take care of those folks. That's kind of the bigger stew that I'm trying to work through and help families get from here to there. I think what ends up happening is that, as I call it, sort of like the New York Times event list, whether it's sort of birth, marriage, death, sale of business, moving, divorce, that type of thing. It's around those events that people sort of come back to the notion of, how does this impact my wealth? My job and our job essentially is to sort of keep clients thinking about that and then making sure that their structures are current, that they address the tax issues that are out there, that they address the creditor issues that are out there, and then to really build in a communication factor so that the real holy grail on all of this is that the legacy that you're trying to create, that gets communicated to the next generation. And then it's not just numbers and commas that get passed down, but it's the values and the concepts that built the wealth and that make you a strong family get communicated down there. That's part of the stew to help make things, address a real pain point for many clients. And say, is my family taken care of and are they going to be good people going forward?
Yeah. And I think that's really important, right? I mean, and let me just try to rephrase everything you just said in a much shorter way.
Sorry.
No, I think it's worth repeating and trying to get to the essence of it.
Mm-hmm.
You start with what you have, and what you have is fundamentally a point-in-time concept, the balance sheet. Off of that, of course, you introduce then a time component, which is things like cash flows and taxes, and the liquidity part of it. Hey, it's great to be worth a lot, but guess what? In the real world, we actually have to walk through time and spend along the way. And that's true whether it's personal family spending, charitable commitments you've made, whatever it is. So you've got all of that going on. Then you've got the weird kind of stress points and cliff functions where something happens in the family. And I like what you describe as the institutional knowledge, or I like your description. I don't like that a lot of the institutional knowledge resides in someone's head. And then at some point you're like, what did, grandpa, grandma, dad, mom mean? Then you've got the whole program of like, I don't really care what you wanted. The question is what's being documented along the way and how do we actually make sense of that? And then the last piece of it, which is I talk a lot about purpose and meaning being the end function of all of this. I say money is dead, you're alive. And that's kind of really important here. If you're not doing the planning around culture and values and making sure that your kids, one, can handle the money, but two, aren't negatively impacted by it, but instead empowered, then all of this is kind of hollow and empty. So I think what you're describing is exactly right.
I mean, you put it very artfully, and a tactic or a factor that I think is really key in all of this is it's one thing to set up these structures, but they are not static and they require maintenance and they require review. And a factor that I think goes well understated in all of this is the concept of who is staffing your structures. Oftentimes people put in older siblings or the eldest child as an executor or a trustee of a lot of these functions. And I would caution people to really think long and hard about that, because that is a massive responsibility. 95%, I'd even say higher than that, of the people who occupy those roles that I see come across my desk really shouldn't in one way, shape, or form. They either are distracted, they don't care, they don't want to do it, they fight, the dynamic isn't worth doing, or they've had a stroke or a health issue or died and they don't even exist. That's something where I would say for anybody taking that away and they say, I just did my stuff, I don't need to change my structures. I would say it's worth reviewing who is occupying the different structures and who the beneficiaries are, because ultimately that's something that can be fixed most times. And it's one of the biggest estate planning faux pas that I see when something comes across my desk.
Yeah, I totally agree. I mean, starting again with the family component, when those things become relevant, emotions often are very high, including loss and things of the sort. And then you've got the oldest sibling who's always been put in the position of, you're the mature one, you're going to be looking after people, whatever it is. And you're like, dude, one, that's a lot of responsibility. Two is like, I'm doing my own grieving right now, whatever it is, right? So there's a lot of that going on, which is really important. And you're right. I mean, particularly when look, you went to law school. I don't mean this as a complete diss, but when attorneys get involved and things get expensive fast, billed by the hour, people are like, hey, I did this 5 years ago. Do I really want to go again? And you're like, it might be worth it. It might be worth at least thinking about it.
And it goes to the notion of having succession and backup plans. I think a very useful exercise for families of any size, but especially for larger ones, is to have a periodic fire drill. What happens if so-and-so passes away? Who do you call? Who's in charge of this? Who's what? You're not having your first bite at the apple at these structures at a period of maximum stress. And I think having some experience with it ahead of an event can save a lot of problems later on. One other comment on that is for those people who are doing planning around a family business or something like that, a lot of thought probably goes into the succession plans of the business, who's running it, who owns it, where does the income go, are we investing for growth? We could have a whole podcast around that. But the integration of succession plans around the family governance structures, whether they're trusts or otherwise, I think should get equal attention, because the two interrelate and there's more damage caused by having a disconnect between those functions than lots of other things that I see.
Yeah. And I think particularly when it comes to the playing things out when the event hasn't happened yet, I think that's really important. Mm-hmm. I think the concept of a pre-mortem is important, which is what happens when, so on and so forth. I mean, look, when you work at a hedge fund or a financial institution, really of any size, you have something called a DR process, a disaster recovery plan, right? And people should have that. They should have a disaster recovery mindset, which is something really bad happens. What do we do next? It doesn't require like going to the secondary trading desk in, Greenwich, Connecticut, because that's not your situation. But the day something bad happens, who do I call first? what do I know about the thing in place so that we can recover from it is fundamentally a personal and human disaster often.
Yeah, everything you just described, I would say, even having something where you list out what the first 2 weeks or 30 days looks like post-traumatic event, so that people have an understanding of what it looks like, why things take as long as they do, where's my check, all that stuff. I mean, you're entering into a world that's not quite as automatic as you may have been used to over time. And to have that experience sort of front-loaded ahead of time, I think can reduce a lot of angst at a time when emotional toll-taking should be devoted to other things.
I totally agree. Look, we could talk about a million things. I'm thinking about things that might be on people's minds on the way out, whether it's digital assets or political risk or taxes in general or anything like that. Is there any kind of quick thoughts on those topics that you think are worth sharing?
So digital assets, I think it makes sense to really, in a sense, create a balance sheet of digital assets. And that can include emails to account numbers to how to access your crypto or something like that, because there's sort of a whole different kind of way of doing things around digital assets that's not quite as analog as some of us are used to back in the sort of wills and executor days. So having a roadmap of how to access things as far as the digital assets go, I think is key. What was the first one you were talking about?
I mean, it could be a lot of things. It could be taxes. It could be political risk.
Yeah, from a political risk standpoint, I'm going to take that in two directions. Number one, when people say things are permanent, I would not listen to permanent and ascribe the word permanent to it, because things can change. They often do, sometimes quickly. In the U.S., we're fairly spoiled, although some people would say that's not the case now, with relative stability and things sort of take time to move and so on. But as I said, the fact that this bill is in place and it's made things quote unquote permanent doesn't necessarily mean that things can't change in the next election cycle. The other part of political risk, at least for U.S. folks, and in for some ways other Europeans, et cetera, is the idea that there are state implications as well. And so, for those of us who live in California and New York, we understand the concept of state income taxes and capital gains taxes a lot more than some people in Florida do, where they doesn't really exist. By the same token, regulatory regimes can change. And as the country has become somewhat bifurcated in terms of sort of political predilection, let's just say, we're going to see places that are more highly taxed and more highly regulated, and other places that are going a little more lowly taxed and trying to be less regulated. I think that it bears in mind, if you're planning a lot of things from a federal perspective, don't forget about the state component, because that can really bite you. In New York, the estate tax, there's a nasty thing called the cliff, where once you get over $7 million, you get taxed back to $0, and that tax rate scales up to 16%. That's a big freaking deal. That can be expensive, and it leads to other discussions about, whether you want to move or do other planning around that. That's a component that shouldn't be ignored.
Well, this was an incredibly educational conversation. We managed to pack a lot in just north of 30 minutes. Let's close on a slightly more fun and personal.
Okay.
I grew up in Paris. I was bathed in French TV. And as you can imagine, the French being as intellectual and metaphysical as they are, of course, there was a culture show on TV that talked about books and big ideas, hosted by a guy by the name of Bernard Pivot, and he asked his guests the same set of questions at the end of every episode.
Okay.
And so I want to ask you the Bernard Pivot questions.
Fire away. Ready? I will do my best to be informative and entertaining.
Great. And again, as metaphysical as you wish to be.
Okay.
This is the French Quarter. What is your favorite word?
My favorite word is... I don't have a great favorite word, but my least favorite word is deserve. I hate it. If you can take the word deserve out of your lexicon and out of your thinking, it opens you up. I mean that from a practice perspective, but also a personal perspective.
I love that. That was going to be question number 2. What is your least favorite word? But I agree. I think the concept of deserving, and I guess my understanding, my interpretation of what you're saying is being owed. Anytime you feel like you're being owed something, that's not exactly coming at it from a place of generosity, I guess is the best way I would put it.
Taken another way too, I think when people look at others, and so sometimes we fall into traps of relative success and so deserves success. I think if you can just eliminate that and people achieve certain things because of a combination of hard work and vision, but sometimes it's luck. And sometimes people are wealthy from circumstances they had zero to do with. If you take deserve out of that equation, I think you just open yourself up to a lot more opportunity. And I think you interact with people a lot better.
Yeah. There's more humanity in it. What is your favorite drug?
My favorite drug is free time. When I have free, unstructured time and I'm allowed to think or absorb, I tend to do a pretty good job. I just feel energized by that. I would say the close companion to that is travel. When I'm in a different scenario that I'm not used to and I'm absorbing something that's a little bit out of my comfort zone, with limits, of course, I find that to be very nourishing, and I usually take something out of it that I really enjoy.
What is a sound or a noise you love?
I love the sound of quiet, but I also love the sound of hard rock music. I like my music to gallop, so faster tempo, drum beats, etc. That works, but I also like quiet when I need to sort of sit back and think about things, and it creates less distraction.
What is a sound or a noise you hate?
The sound of complaining drives me crazy because it usually means that we're not trying to solve things. We're just sort of exacerbating conditions that we all can see out in front of us. And so I don't like that. That it is the close cousin to me to fingernails going down the chalkboard.
Got it. What is your favorite curse word?
Fuck.
Who would you like to see on a new banknote?
Good, tough question. Gosh, sorry. It's almost like I should pause and go look something up. But I'd like to see Pat Tillman on a banknote because I think he is an interesting intersection of what this country is about. He was good at lots of different things. He had a level of success across different different things. And then he went back and served in the military. He died very unfortunately. But I think he is an example that future generations should look to as something that really emphasizes what citizenship should be in this country.
I love that so much. What profession other than your own would you never, ever want to attempt?
I would be a great bedside manner doctor. I would probably be a horrible surgeon.
Okay.
I'd tell you everything was going to be fine, but then to go in and sort of make it happen in the brain of the heart, I don't know. I'm a little too twitchy.
If you were reincarnated as a plant or an animal, what would it be?
I'm either going to be a golden retriever or Bernese mountain dog, probably. Friendly, hardworking, and at the same time, able to perform lots of different weird specialized functions.
Well, that's great. One last question. Are you ready?
Fire away.
If heaven exists, what would you like to hear God say when you get to the pearly gates?
What I'd like him to say, which is not going to be the case, is that you did everything with the talents that you had, but what I would hope he would say, he or she would say, is you were a really good person.
Well, Frazer Rice, I think you are a fantastic person. So I may not be the big guy or the big gal, but take it from me. I think you're pretty fabulous. I'm super grateful you were on the show, and thank you for sharing your knowledge, and thank you for sharing your gift and your humanity. There is a certain godliness to being a French Californian. I'm gonna take that compliment and enjoy it for the rest of the day. Appreciate it, Jonathan. You ask great questions, and I think this show does a lot to help educate people, and I hope I chipped away at some complicated stuff for folks. Well, I know for a fact that you did, so thank you. Thank you.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, treussard.com, for additional information and disclaimers.